Currently, we're accepting Bitcoin and ETH as margin collateral. From a technology perspective, we're well versed in managing crypto assets. We've been running an exchange that has physical delivery for years now. And that runs through a settlement facility that we operate. From a regulatory perspective, we actually think it fits quite nicely with the already existing regulations and kind of guidelines that the CFTC has for accepting other margin collateral types. Gold, for example, or treasuries, stocks, different currencies. It fits right in with that. And the risk models are really no different. We do appropriate haircutting of the collateral that allows us to give plenty of breathing room if we need to liquidate those assets. But for the most part, Bitcoin and ETH are some of the most liquid spot commodities that humans have ever seen. So the liquidation risk and our ability to use that collateral in moments of strain, actually, we're very confident in. I think there's a very deep desire to put these assets to work, and collateral for futures and options trading is a great place for them. And that's what we're doing.
Why did Bitnomial form your own clearinghouse?
This comes down to what incentives do we have with any other clearing partners. So we used to use MGX Futures, which is a part of MyX Group. So they have their own clearinghouse, and they do something called horizontal clearing services, where they'll sign a clearing services agreement with other exchanges to clear their contracts. So we worked with them for, I believe, 5 years. But ultimately, I think they didn't have the same vision for the crypto industry as we did. And as such, we're kind of unwilling to move into areas that we thought were necessary and sufficient for the industry to grow onshore. And so, one of those things was, eventually using, crypto as margin collateral. I think that was kind of well outside of the wheelhouse. And I suspect they didn't want to do it. And they certainly didn't have any clearance from the board or any really desire to do that at the organizational level. And so we recognized this early on and decided to build our own clearinghouse, kind of in parallel with working with them. And look, we've always wanted to do this. This has been a part of the business. Having a DCM and DCO is a very powerful combination of our space. And quite frankly, I think a lot of the innovations in the crypto space in the US all come from clearing. And you can't do those innovations if you don't own their own clearinghouse. So that's what that allows us to do. It's an understanding that takes a second to realize when you get in the exchange business. You realize most of the hard work and most of the capital efficiencies and what customers want is actually just a function of clearing.
Can I use my Bitcoin as collateral to trade anything?
There's some nuance here, unfortunately. From the clearinghouse level, you can put down these assets and trade anything. However, the restrictions come from an FCM from the guidance from the CFTC in 2020, which requires that any digital assets used as collateral must be for physically settled contracts of the same kind. So, for example, if you put down Bitcoin, it can only be used to margin Bitcoin, physically settled Bitcoin contracts at the FCM level, although the clearinghouse has no such restriction. But if FCMs can't do it, then we really functionally can't. If that guidance gets removed, I think that opens up to being able to use Bitcoin to, for example, margin S&P 500 trading or treasury trading or whatever else people want to do with it. But right now it's restricted to in-kind physically settled contracts. And that's what they're used for currently at our exchange.
How did you work with the CFTC for approval on crypto margin collateral?
The CFTC has a framework for clearinghouses to accept different collateral types, right? So I don't know the specific regs, but there's a couple of requirements that they need. Most around obviously who controls the asset, who holds the asset when it's on deposit, the ease of access of liquidating that asset when you need to be able to, the volatility of that asset, or if it's just appropriate collateral at all. We've found in working with the CFTC, and we've proved that Bitcoin and ETH so far do meet all those requirements. What's nice about Bitcoin is that you can go and actively measure in all of the many markets that currently exist to know, hey, what is my liquidation risk? Or, hey, if I have $100 million for the Bitcoin, how much can I liquidate? What will be the slippage be on that? Obviously, there's a liquid spot market. The OTC brokerage market for this commodity is very deep and well understood. There's a lot of OTC partners that we work with. And so it was pretty easy to explain to CFTC that we can use these in terms of turmoil. I think from a liquidation and waterfall perspective, obviously we treat it in customer seg. It has to be held by custodian, which we are a custodian with a clearinghouse license. So that allows us to kind of hold those assets and manage them when we need to.
How much market share or trading volume should move onshore to reduce systemic risk?
The offshore markets were able to move a lot faster than the US markets because of regulatory regime. So they're able to start up, gain traction market share with no oversight, which means that they can build features way faster than we can. They've done that, and market volumes are substantially higher offshore right now for the derivative space. That goes from centralized exchanges all the way to decentralized exchanges, and what they list and what they can accept as collateral. The risk is that since there's no or little oversight with those exchanges, we don't know what would happen in a sort of a cascading, default or liquidation scenario. As you know, there's a lot of firms that set up offshore entities to utilize these platforms, and they typically have some relationship with U.S. entities. So the spillover effects are very real. I think that as the crypto industry kind of becomes more ingrained with traditional finance, particularly with banks, obviously banks are looking to get in to the industry now because of the regulatory basically guidance and sort of more surety than they've ever seen. That as crypto becomes more part of the lending and credit industry, any big substantial offshore exchange defaults or liquidation could spill over to the United States. It's easy to see that. I don't know exactly what number or what we would need to see onshore to mitigate that risk. I would probably have to say a lot more. I think some exchanges onshore have pretty decent volume, still not compared to offshore. So I don't know what that would be. I don't have an exact number, but it needs to be a lot higher than we are now. And I think what's stopping us is that it's just so much cheaper and easier for people to trade offshore with offshore entities. Because look, if we're the only ones in the US that's taking crypto assets as collateral, that's just table stakes offshore. I mean, they have all the ability to do that. They have ability to do portfolio margining. They have ability to accept all sorts of different types of customers. And they even have the ability to, potentially not guarantee the trades that they're clearing. I mean, the clearing models are unknown, they're untested, and I think while it does look cheaper and more liquid, who knows what will happen in periods of stress, or for any frauds going on. I mean, look no further than FTX. I mean, they just stole customers' money. So things look good offshore until they aren't. That's not how that is in the US. So I want to see that change, and I want to make sure that those risks and those spillover effects are limited so that the US can have proper regulatory oversight of these products in this asset class, which is only growing, and will be substantially larger in the next 5 to 10 years.
Do you have plans to expand clearing outside of crypto?
Right now, we're focusing on crypto because that's where we have the most traction and expertise. All of our clearing members that we support right now, that's where their customer base is driving them to. So I think that has been our main and primary objective. And not only that, but we felt it's been the most underserved. Being able to take Bitcoin as margin collateral is our first step into serving those customers who are Bitcoin rich but cash poor. And I think there's a lot of entities out there, particular miners, institutions, other hedgers, and basically people in the that are financing these operations have that. So that's who we're here to serve first and foremost. If it turns out that there are other product groups or asset classes that are useful to them, we're more than happy to list those products as well. I mean, I think you can, easily imagine us listing other, maybe, cash settled index products that are very similar to what's currently out there, or maybe some of them that are a bit different. And I think as we, evolve and we're allowed to ultimately allow people to use assets on their balance sheet to margin those trades, I think that's kind of where we will get the most traction and where we'll continue to grow.
How does cross-asset margin work with both spot and derivative positions?
Being able to put down a commodity that's directly tied to your futures position, I think is very interesting and useful. Look no further than like the treasuries market. Putting down treasuries to collateralize treasury trades makes a lot of sense, but you can't typically do it in traditional like ags or energy markets, right? You don't typically post down oil or corn or wheat to collateralize your trades. Typically, you have to have some sort of complex financing arrangement through some sort of credit union or third-party bank or lender. In our situation, it's really great for people to go buy the commodity and put it down directly at the clearinghouse. That way, the cost of carry is as cheap as it can be. Trade financing doesn't stop there. You can go and kind of, there's all sorts of different things you can do with that. But I think that's where the main capital efficiency comes from. It's the fact that you can use a directly correlated underlying to the actual asset that you're trading. And I think That's a very unusual case. That's not very common in the commodities world, but I think this is the most classic, clear-cut example of how that can work, and that's why it's the most capital efficient.
How do you ensure crypto on your exchange is clean?
That's an ongoing issue in the space. We have a couple things. Traditionally, we do KYC, AML. As you know, all the FCMs do that. We even have an additional layer at the exchange and clearinghouse, depending on what you want to do there. For example, if you go into physical delivery or crypto's collateral, we do additional KYC verification so we know who you are, who's posting it. Further, if you do post Bitcoin, we do have blockchain surveillance tools that we use at the CFTC and other regulators are very keen on us using, and we've used them so that we can trace it. So, for example, if someone starts sending us Bitcoin from like OFAC Bitcoin at known addresses, like that's immediately flagged. So we're able to, look at that and verify it and report and investigate on it. I think that's an important part of this process. And it's ultimately, even if it's not from a direct bad wallet, it allows us to kind of systematically detect if people are putting Bitcoin that is maybe one or two hops away from some undesirable sources. So that's all built into the system, and that's been working for a long time. And the CFTC has been very keen on us doing that, and we've been happy to do it.
How would crypto collateral perform during a broader market stress event?
Part of the process of accepting crypto's collateral is making sure our risk management framework takes into account stress periods. So we have our historical scenarios that we run through, and we actually that's how we decide how much Bitcoin or ETH we can take at any given time from a clearing member. For the purposes of crypto's margin and the appropriate haircuts after the fact. So those are all things that we model and manage continuously. Those are models that the CFTC's reviewed that are pretty basically tried and tested throughout the industry. I think the fact that they're Bitcoin or ETH really makes no difference because we're applying the same kind of methodology across all different types of commodities. But yeah, we've seen performance go pretty well. Obviously, throughout time there are periods of stress, but surprisingly, I guess or unsurprisingly, Bitcoin's been fair has its volatility has decreased dramatically in the past few years, and so we've seen that we're able to hold it with confidence in any scenario.
What does crypto margin collateral mean for different types of market participants?
The reason why we do this is because of customer demand. We have a lot of market makers, institutionals, and hedgers that, like I said before, are crypto rich and cash poor. And so what they want to do is they want to provide liquidity to the markets. They want to hedge their exposure. They want to, in case of institutions, sometimes they want to gain that exposure. But the only thing they have is crypto, and they should be able to use that to fight to deposit for these trades. I think that's exciting for them. For example, there's market makers that get paid in crypto. There's market makers that get loans in crypto. There's market makers that be on the other side of basis trades and they understand the risk of this, and that's what they want to put down and to manage it because it's much cheaper to use than dollars. One kind of example is the lending markets. So, for example, if you want to borrow Bitcoin, you can borrow Bitcoin annualized for 3 to 4%. That is much cheaper than borrowing cash. So there's an entire liquid pool of people sitting on Bitcoin that want to lend it out for anything. And so trade financing seems like a great liquidity injection point for them to do that. As you know, Bitcoin isn't really it's an asset that doesn't inherently yield anything. People hold it for price appreciation. So being able to take an asset that has traditionally no yield associated with it and allowing people to lend it out to market makers and liquidity providers, it's a great way of making use of that asset. I would say for the hedger's perspective, if they want to hedge their price risk, as you know, if you do it right now, it's dollar intensive. You short a futures contract, the price rallies, you have a lot of dollar difference to make up for on variance. Well, with Bitcoin, it tracks pretty well for that, so that's really useful to them. And I think institutions look no further than all of the kind of Bitcoin treasury companies. Now, there are these companies that are putting Bitcoin in balance sheet. The more the more they can do with those assets, the better. And so that's what we're opening the door for. So it should add quite a bit of liquidity to the commodities markets.